Hey, there's a popular narrative circling online that goes something like this. Bonus depreciation is back, so you should just go out and buy a big SUV and write it all off. Well, listen, while that's true that 100% bonus depreciation is back with that big, beautiful bill, the question for you is in 2026, does this make sense for you? I'm going to break that down in this video. All right? Let's get started. Okay, so when it comes to writing off a vehicle, there are a lot of questions that go into this, and a lot of people get this wrong because they hear about the fact that they can write off the vehicle and they think, oh, I'm just going to go out and buy a car and deduct it. What I'm going to be sharing with you is when this makes sense and when you should pause before moving forwards with that next vehicle purchase. And so I'll be showing you in this videos how those numbers actually work when you're buying these vehicles and what that tax deduction is actually going to put back in your pocket. And then when we get done with that, I'm going to get into when you can run into trouble with buying a car and writing it off. Okay, so what are we looking at here? Well, before we get into the depreciation and taking advantage of all the tax deductions, I want you to understand this. The biggest question that you need to address when it comes to writing off a vehicle is, hey, how much use are you going to have? And that is the question right there. Are you going to be using that vehicle at least 50% of the time for business use, not only for 2026, but for several years into the future? Listen, this is not a question of whether or not, as I stated, you're going to use it for business right now, but you got to keep that business use up. Because if you go out there and you're thinking about writing off a car here in 2026 against your taxes, and you make a change in that use, you're going to find out that could come back to haunt you. So why do I keep bringing this up? Because people have done this before. I've seen clients that will go out and buy a car and then quit using it because A, their business doesn't work out, family needs, they have to travel to a different state and they can no longer spend the time in their local business. There's many different reasons why your business use may drop less than 50%. And so if you're wondering right now when I say drop below 50%, yes, you can buy a vehicle, use it in your business, and as you're going to see with the numbers, as long as it's over 50%, you're going to be qualifying for some deductions. So that means you're using it for business and you're using it for personal. It doesn't have to be used 100% of the time in the business in order to get tax breaks. But what's critical here is you have to have that business use. Now, the next significant confusion is around the vehicle weight. Okay, so here's the deal. The IRS uses this term called luxury vehicle, but it's misleading, right? So for tax purposes, a luxury vehicle is any passenger vehicle under 6,000 pounds gross vehicle weight. It doesn't matter if that car is a Kia or a Porsche. If it's under 6,000 pounds, then luxury auto depreciation caps apply. And people get so confused. They think that the fancy cars are the only ones that have to deal when you're considered about a luxury automobile, because that 6,000 pound gross vehicle weight limit, as you're going to discover, comes into effect when we're talking about your tax deduction. So you could really effectively neutralize any of the bonus depreciation you've heard about if you don't have the right type of vehicle. That's why buying a $70,000 SUV that weighs less than 6,000 pounds isn't going to give you a huge deduction and might result in a disappointment when it comes to preparing your taxes. Now, price doesn't matter, it's the weight. So here's what we need to look at now. You have to know you're going to use at least 50% of your time for business, and you've got a vehicle that weighs over 6,000 pounds. Those are the two numbers we're going to be focused that you have to focus on. All right, now let's talk about how this works in real practice. I'm going to give you now some numbers so you can go through this so you understand it. So here's what I'm going to do. I'm going to start with a certain set of assumptions here that's going to apply to all the calculations. So let's assume we're looking at a vehicle that cost $70,000. That is the vehicle price. All right. Now, in addition to this, let's also assume that you're going to use that vehicle 80% business use. Okay, and you're in a tax bracket of 35%. Okay, so these are the assumptions we're making. Then I'm going to break this down for you, vehicle that weighs over 6,000, under 6,000, and we're going to talk about the mileage deduction. All right, so let's start off first with mileage. Let's assume that you're going to drive your car for business 18,000 miles a year. So you're going to put 18,000 miles a year on vehicle. So how does that look from a tax deduction standpoint? So when you're using the mileage deduction, essentially what you're doing is you have your business right over here, and you're out there driving your personal vehicle. So I've got my car right here. I'm driving around for business purpose, and then I'm submitting for a reimbursement to my business. And I'm telling my business, hey, I drove 18,000 miles this year. I put on my personal vehicle, so you need to reimburse me for the wear and tear to my car. Now, the IRS releases what is called their standard mileage rate, and currently in 2026, that's 72.5 cents per mile that you drive. And so this gets real simple from a math standpoint. Now, all you need to do is multiply 18,000 miles by 72.5 cents, and that's going to equal roughly $13,000. So what does that mean to you as the business owner? That is your business here, so this is my business. It can pay me $13,000. Write me a check, and I don't have to include that in my income, right? Because it's non-taxable to me. It is a reimbursement. Now, for those of you that have a business, right, it's a flow-through business, an S-Corp, sole proprietor, at a 35% tax bracket, like we talked about up here, this $13,000 deduction to your business is going to equate to essentially $4,500 in tax savings. You're going to get a $4,500 tax savings with that deal. Now, there's no depreciation, right? No recapture, no surprises, nothing, right? If your driving habits change and you drop to 10,000 miles the following year, well, then it's 72.5 cents, unless they've, of course, increased it, multiplied by the 10K that you drove. So mileage is really simple. Now, the one caveat here, if you're going to go with the mileage deduction, you have to be aware of this, and this is where people get into trouble, and that is they do not track their miles as they're putting them on their vehicle. And I've read a lot of tax court cases, I said cat, I meant tax court cases where individuals have been audited and then they try to go back and recreate their mileage log. Do not do this. There's plenty of apps out there. Mileage IQ is one of the more popular ones where you get in the car, you hit business, and it just starts keeping track of your mileage. And then when you get done, you indicate what you were driving for, and it keeps a log. That is your best defense to an audit here, especially for those of you that think you're going to put on 18,000, if not more, mileage on your vehicle, and you're taking advantage of this deduction. Keep that mileage log. If you don't have it, you're probably not going to get the deduction on an audit. They're going to disallow it. All right, now let's talk about buying a $70,000 SUV that weighs under 6,000 pounds. Okay, so as I talked about earlier, let's go over here now. If you're buying that vehicle and it's under 6,000 gross vehicle weight. Okay, so now this is a what? Luxury automobile. Okay, so now we have different rules that apply here. So when you're buying this type of vehicle, all right, it doesn't matter what the vehicle looks like. In the first year, your depreciation is going to be capped at roughly $18,000 before applying the amount you're using it for business. So if I bought this $70,000 vehicle here, then the deduction I'm going to be looking at in the first year is the most I can write off is $18,000. However, since I'm only using it 80% of the time for business, I need to take that $80,000 and multiply it by 80%. Now, when I do that, what's that going to equal about? Let's say about $14,500. Okay, that's a rough estimate. So at a 35% tax bracket, like we did in our previous example, what is the practical savings to me, okay, in this example? Well, at 35%, you're roughly saving about $5,000. Okay, so it's a little more than what we had in the mileage, okay, but it's not a lot, okay, when you go this route. So looking at, as I stated earlier, the gross vehicle weight is critical if you want to maximize your tax deduction if you have a vehicle that you intend to use in your business. So this is where the numbers change materially. And this is what a lot of times people are talking about when they're saying, hey, with the new tax law, you can write off your vehicle. Well, you can write off the business use of the vehicle. So what does that look like? All right, so let's assume the same example here. We have that $70,000 vehicle now, but it's over 6,000. Okay, so now we're over the 6,000 gross vehicle weight. Now, in this example, all we have to do is take your business use, and since I said it was 80%, we'll just say 70,000 times 80%, and so that's going to bring us down to $56,000, all right? That's simple math right there. So this is the amount that we're going to be able to write off. That's all you got to do. It's an easy calculation to make. 80% of the 70,000, $56,000. So at 35% tax rate, that's going to be about $19,500. Let's just say $19,500. It's going to be a little more, but that's close enough. So if you look at what we had there, we had $4,500 with the mileage. We had $5,000 if you buy a car that weighs under 6,000 pounds. And if you go over the 6,000 pounds, which is easy if you want to buy an SUV or a truck, then you're going to get $19,500. Okay, that is real money you're going to be able to put back in your pocket. And this is the scenario most of the people online that are talking about this are referring to. And it's a legit strategy to do this. However, what they typically don't tell you, and this is why you're watching this video right now, is because you need to understand this, is that one of the main rules I told you from the very outset is that business use needs to meet this 50% threshold. Okay, so if your business use, let's say 2 years later, drops to 40% due to growth or lifestyle changes, who knows? Okay, at that point, the IRS is going to treat that accelerated depreciation as improper and require you to recapture it. So instead of having been allowed to deduct the full $56,000, you may have only been entitled to deduct approximately $16,000 under the straight line rules, and now you got to pick up on your tax return, get this, $40,000, right? You're going to get taxed on that money. That's going to be income to you. So that means you're going to have to pay an extra $14,000 to the IRS if that were to happen. Now, this is the outcome that surprises most business owners because they do not understand that if you're going to be using a vehicle in your business, you got to have longer term prospects here to keep showing that it's over that 50% threshold. And if there's any question about whether or not you can meet that threshold going forwards, well, then buying a vehicle in 2026, does it make sense to use the accelerated depreciation or just use the mileage deduction? So in many cases, the way I would approach it or recommend you approach it, if you can't give yourself some assurance you're going to do that, go the mileage route, right? And just write those miles off every year, take that deduction. Eventually, you're going to get there to this amount. Now, if your vehicle is under 6,000 pounds, probably the mileage is going to be the way to go, unless your mileage is not high. So in the example that I provided you, the mileage is at 18,000. So this is another level that I didn't get into that you should be aware of, and you can go over this with your tax professional, that if your mileage is going to be somewhere in the neighborhood between 7 to 15,000, well, maybe it's better to go the other route and look seriously at the straight line, taking the depreciation, or going the route here that I just showed you and writing it all off. For those of you that wonder or sitting here watching this thinking, well, maybe this isn't a concern for me because I can show business. Absolutely. If you can show you can keep the business use going, maybe you set up a corporation, you're managing your own rental real estate and you're driving for that, just do that. Have a second vehicle that you use for personal use. And so majority of the miles you put on that vehicle are just business miles. Hey, you can get there as well. So there's lots of ways to do this. The key though is that you sit down with somebody who understands how all this works. Don't follow the internet gurus who are just telling you to go out and buy a car. It may not be in your best interest. If you want to learn more and talk to one of our strategists about deciding what is the best approach for you, go into the show notes. I have a link there for a free strategy session. Hit that strategy session. We'll set you up and you can talk to one of my advisors here at Anderson and they'll walk you through this process and put you on a better path to 2026 and keeping more of what you earn. Take care.